Hi everyone, welcome to the Value. So today we're going to talk about two satellite imagery companies that are worth buying today because they just got US contracts worth billions of dollars, and it kind of just changes the whole game, and it also proves how good they are at what they do because of the value of these contracts and who it is with. First one is Maxar Technologies. This is a company that is worth about $2.2 billion on the market right now, $29.86 per share. And how much was their contract worth? Their contract was worth $3.24 billion over 10 years. And basically it means this company will be generating around $300 million a year. So as it says, Maxar's contract means $300 million a year, and that can grow as high as $340 million a year. And that's for a company that's selling at $2.2 billion at the current situation. And if we look at their guidance for Earth intelligence revenue guidance was $1.17 billion to $1.2 billion. And overall revenue for the company will be about 1.8 billion to 1.85 billion. So, it really adds to those numbers in quite a good way. Like, it's not really significant, but it's significant enough that it's actually going to make a good difference. And this is a company that is actually on the cusp of basically being very profitable. So if we look into their recent first quarter revenues, their revenues was $405 million with a net loss of $7 million. So they're literally on that break-even point. And if we look at the adjusted EBITDA, that's $84 million. So immediately, if they didn't have capital expenditure, then they would be a very good cash flow business, because basically their operating cash flow is $48 million. So immediately they are in that sweet spot where they aren't showing a whole lot of profit yet, but the years after that, the profits are going to be very nice. And basically, you get in at a really good price today for a company that's just going to be so relevant for the future, basically as long as you can think, because satellite imagery is not going away. It's actually getting more relevant, and the way they can interpret things as well, it just gets more and more important as we go. And that's the same with Blacksky Technologies, who did really well, going up 24% yesterday, but obviously on a pre-market it's going down 10%, but that's irrelevant. We're looking at the long term of these companies, and we're going Blacksky Technology, who has risen a lot. You could have gotten this company at a fraction of the price. Like, they were selling as low as $1.18. But we can't look at the past too much. We have to just look at the present, and at the present time the share price is $3.27, a valuation of $394 million. And how much does this change for them? So Blacksky, their recent quarter revenue was about $13.9 million, and that was up 91% on the prior year. So that quarter was $13.9 million. And now we have to go, how big was their contract that they got? So their recent contract, they got a 10-year contract worth $1 billion. Now they don't get, it doesn't work quite like as Maxar's one, so it's not like $100 million a year, but eventually it could be about $100 million a year, because if we divide that $1 billion by 10, it's about $100 million. So for the first 2 years, it's actually lower. So on a third year for the company, the contract value is going to go up by quite a bit. So for the first year, they get about $71 million as allocated for the first 2 years. And then, as I say, the total contract with options is valued up to $1 billion, and that's based on 5 years base period performance, and then with an additional five 1-year options that can be exercised. So you can kind of do the numbers, and you can kind of go like, if the first, basically, there's a starting with so on May the 23rd, with a 5-year base subscription with a starting value of $85 million for the company's imagery services, of which 71 million was allocated to the first 2 years, and basically there's kind of options that can kind of build that up to $1 billion. So you can kind of do the math, and we don't have all the details, but it basically means there's a lot of revenue coming their way. Now, if we divide that 71 million by 2, that's about 35 million per year extra, and that's actually significant revenue for Blacksky, who basically did 13.9 million for the first quarter. They're looking probably about 50 million or so, 50-60 million for the full year. So to add another 35 million from these contracts basically gives them immediately a 50% jump. And that's not to count the other revenue that is going to be a big boost on top of that. So immediately you can kind of see that these companies are really, really relevant and are actually selling at a really, really good price right now. They were selling at a better price before the announcement. And these companies were really, really undervalued. That's because the revenues were really, really small. But now if we look at a company and we go, next year this company potentially does 100 million in revenue or more. So if they do 100 million or more in revenue next year, then basically they'll be only selling about 4 times revenue, with basically the company growing at a really, really good rate. So this is a company that grew at 91%. So growing at 91% is a really, really good rate for the recent quarter. So it kind of just shows you that the company's growing really, really quick. But if you don't want a company that's growing quick, because at the same time they are losing money, they had a net loss of $20 million, but there's a good part of that was stock-based compensation, and they have adjusted EBITDA of 9.5 million. So that kind of lets you know what you're dealing with, that hey, you've got a smaller company growing quicker, but kind of burning a bit more cash, but they do have 138 million cash, so that's not too much worries for the time being. But if you want to steady a company, Maxar is the larger one that's basically on a cusp of breaking even, and in basically they're ready to make some really, really good profits. So for basically the investors that kind of want a company that's more defensive in terms for your portfolio, that's not going to have that's going to be a much more stable. Well, Maxar is probably one, because literally it is making good earnings this year itself, and it's also paying a dividend. So for April, they approved their first a regularly quarterly dividend of 1 cent. Now 1 cent's not a lot. Times it by 4, that's 4 cents for the year, which is not a lot for a share price that's up $29. But again, this is just a start. Like, management won't approve dividends unless they think they can do it on a continuous basis and do it at a consistent basis too. So there we go. We've got 2 companies, one that is more stable, still growing all right. Like given that their contracts are quite kind of like, they have to sign these large contracts, so they jump up occasionally and then they kind of like flatten. So this isn't the type of company that you would expect the growth to be very consistent. It's good one moment, down one moment, kind of like. So we won't measure the growth. We won't be that harsh on these companies when it comes to measuring the growth. I don't think they grew that much. I think they grew very, very marginally, if I can find where it says this. Yeah. Oh, okay. So where we go. So last year's revenue was 392 million for the quarter, and they only went to 405. So there we go. But you can see they've reduced their net loss by a massive amount, which is basically where you really want these companies, where they know what they want to do. They've done the cost cutting, and basically you can see like product costs has gone down from 148 million to 127 million, and everything else has stayed relative, except the selling expense has gone up. And overall, they've managed to go from a loss of basically 84 million, though a large part was interest expense. They did repay a good amount of debt, and it's been able to reduce quite a bit of reduce about $55 million in expense, and the rest of it was from other cost savings. So basically, if they increase their revenue and those margins really come through, then basically they're a very profitable company from that basically at that time. So once that contract of 300 million per year starts to filter through into these extra revenues, then you're going to see a very good, healthy, profitable company. One that's also going to be very relevant for a future. So you're kind of investing in a very nice company that, will just keep growing and growing and growing, particularly with Maxar being the leader. And if you like the high growth kind of areas, then Blacksky will be the choice of that. If you like the stable one, Maxar will be the choice for that. If not, just take some exposure in both. That is, if you like this type of area and you think it's something that you want to be in, particularly satellite imagery, you can kind of imagine what it'll be used for and how useful it is in the future. If you've got any questions, post below, or until then, good luck investing, everyone.